Welcome to this presentation of Making Democracy Work with Money Reform. My name is Mary Costello. I'm a member of the League of Women Voters of Athens County, Ohio. I'm also a board member of our local league and a past president. We are representing in this presentation the content of the session we conducted at the LWVUS National Convention this summer. The specifics are the same, but we have added a speaker. And I am hosting in place of Debbie Schmeeding, who hosted the Caucus presentation at the convention. Our content speakers are John Howell, Marie Werner, and Virginia Hammond. John is an associate professor of physiology emeritus at Ohio University. When he retired 12 years ago, he learned how deeply our money system affects our economy, our politics, and our culture. He serves on the board of the Alliance for Just Money and on the board of the League of Women Voters of Athens County. Marie Werner joins us from California, where she's a member of the Mount Baldy Area League of Women Voters. She is retired from a career in technical writing, and she's the writer of the Workable Economics website. Virginia Hammond joins us from Portland, Oregon. She's a member of the Portland League and is co-author of How We Pay for a Better World. She's a recent member of the board of the Alliance for Just Money, and she is an avid quilter. She has created more than 50 quilts that illustrate how the money system works. And while you won't hear from them directly in this presentation, Suzanne Howell and Debbie Schmeeding, both from the Athens League, have been key partners in moving this project along. We began with these questions. In what way does the current federal money system support or undermine the values of the League of Women Voters? And are there alternatives to our current system? Big changes are taking place in the federal money system, changes that affect issues the League of Women Voters supports. We felt we should have a voice in how these changes are undertaken. At the same time, money is a tough emotional conversation for most of us, whether it's at our kitchen tables, within our respective state budgets, or in the news from Washington. We hope to unpack some of the density of the topic in this presentation. And we ask for your support of our proposal for the LWVUS to engage in a national study of the U.S. money system. As you know, the League of Women Voters was founded in 1920, when white women had only just gotten the vote. This was a huge step forward, but many people in the nation still face severe obstacles to exercising these rights. And the League has broadened its efforts to work for a better democratic practice all around and a better world. For over 102 years, the League has been dedicated to empowering voters and defending democracy. And we're not there yet. We have a long way to go in some of our policy areas. Advocating for a money system that supports our goals could leverage our efforts. Supreme Court Justice Louis D. Brandeis said, quote, "We can have democracy in this country, or we can have great wealth concentrated in the hands of a few, but we cannot have both." We can see the truth of this statement. A wealthy few control public policy, too often determined by what is profitable for them instead of what is best for the common good. Why is this happening? Through our study, we discovered that we have a money system that systemically transfers wealth from the many to the few, increases inequality, and allows profits to be the nation's highest priority. As League members, we work hard for fair and honest elections. But how can we ever have fair elections while concentrated private wealth can manipulate them? We asked, how could the money system be changed to support League values and policies? And we came up with and proposed a set of 9 features for such a money system. Because concern about the money system is new to many, we did not ask for concurrence at the convention, but we asked that the League take this issue on in a study in order to prepare itself to be able to advocate for or against changes in the system that are beginning to emerge. So what is the money system? What does it do? How is it relevant to the League of Women Voters? Why consider reform? So let's start with these questions. Note that we will refer to what is formally known as the monetary system, also with the term the money system. The money system regulates the money supply. It introduces money into circulation and withdraws money from circulation, either increasing or decreasing the supply of money. For instance, when the Federal Reserve increases interest rates, it is trying to decrease the rate of growth of the money supply. The term fiscal is related, but it doesn't refer to the creation of money. It refers to the avenues through which money comes in as revenue and goes out as spending. It deals with the flow of money that is already in the system. Government fiscal policy determines what the government spends its money on. The money system affects fiscal decisions. The money system creates our money and enters it into circulation, and we'll see how this works in a moment. The system provides a means of payment for transactions, for buying and selling and giving, for paying and for receiving salaries, etc. It consists of government agencies and private financial institutions like banks and credit unions. It is established and regulated by law, including by the Federal Reserve Act of 1913 and its subsequent amendments. The money system affects democracy itself because money affects political decisions. Increases of wealth lead to increase in power. Increased power leads to increased wealth as those in power change or bend laws and regulations in their favor. It is a self-reinforcing cycle. Concentration of wealth is a natural process which occurs in most, if not all, societies. But in societies that are committed to the liberty of all, it is the responsibility of government to limit wealth and power concentration, to make democracy possible. Money systems can support democracy or can instead undermine democracy. As League members, we work hard in support of fair elections, but elections mean less and less as wealth and power are concentrated into the hands of a few. Monetary policy affects fiscal decisions. As reflected in the League's policy guide, Impact on Issues, a guide to public policy positions, the League advocates for environmental protection and for taking steps to minimize climate change. It also advocates for the support of families and children, for preventing or reducing poverty. It supports government expenditures for education and for healthcare. All these things require the marshaling of society's resources. They require funding at the national, state, and local levels. These fiscal issues are affected by the money system, which, in controlling the money supply, determines who creates the money and who gets the money when it is created. The Athens County League study began with a question about the monetary system raised by one of the board members in January of 2021. Out of that came the suggestion to give a caucus at the League of Women Voters of Ohio State Convention. A committee was established to carry that forward, and a caucus session was given on May 14th, 2021. The committee then conducted a series of 9 education sessions over the summer of 2021, engaging people from other league chapters in Ohio and bringing in league members from other states who have interests in the money system and its effects. Those sessions resulted in the proposal we are describing to you today in this presentation. The proposal was then endorsed by the League of Women Voters of Athens County in an open consensus meeting called to consider the proposal. It was subsequently endorsed by the board of the League of Women Voters of Athens County on February 24th, 2022, and then by the board of the League of Women Voters of Ohio on March 12th, 2022. And with that introduction concluded, I'm going to turn it over to John Howell. John?
Thanks, Mary. Now let's look more closely at money systems and particularly our own. We'll be showing graphs, and unless labeled, the data are all from the Federal Reserve System. The money supply is not static, it grows. Here you see Federal Reserve data indicating the rise of the money supply from 1960 to 1920 to 2022. You can also see that just within the past year, the money supply has increased by 2.2 trillion. Well, where does all this money come from? What agency or agencies are creating it? Well, to answer this question, we have to recognize that there are different kinds of money. For those of you who answered government, you're partly right. The US Mint does make the coins, and since the face value of the coins is more than the cost of making them, the government makes a little profit creating coins, and it spends the profit into circulation. Now, for those of you who chose the Federal Reserve, you too are partly right. Bills are printed by the Bureau of Printing and Engraving and issued to commercial banks by the Federal Reserve banks. Commercial banks then make them available to you and me. It can therefore be said that the Federal Reserve creates bills as money. That's why it says on them, Federal Reserve notes. Now, the third kind of money is account money. It is through account money that we are paid and we pay our bills. Even purchases of small items are now often done with credit or debit cards, not with bills or coins. Most of our personal money exists only in bank accounts of some type, not as coins or bills. The total money supply is the sum of coins, bills, and account money held at banks, all circulating in the economy. But by far, the most of our money, by far, most of our money is account money. The most correct answer to this question, therefore, is neither government nor the Federal Reserve. The most correct answer is banks, because account money is created by banks. So bills and coins comprise about 5% of our money supply, and all the rest is account money. All account money is created by banks. It's created by banks as they make loans. When banks make loans, they don't transfer money from anyone else's account, savings account or checking account, to give to a borrower. They create new money with every loan they make. That may strike some of you as preposterous. I thought it was when I first heard it, but it's true. These are words of the Chicago Federal Reserve Bank. says the actual process of money creation takes place primarily in banks, when the proceeds of loans made by the banks are credited to the borrower's accounts. And in simpler language, the Bank of England simply says the majority of money in the modern economy is created by commercial banks making loans. So now you know, the bulk of our money, all of our account money is created not by government and not by the Fed, but by banks in every community where banks are making loans. The money supply goes up with every bank loan that's made and goes back down as bank loans are paid back. So now let's look at some of the consequences of the money system that we have. And in order to do that, it's useful to compare our current system with at least one alternative. And the two systems we will compare are first the money creation by private banks through lending, that's on the right of this diagram, and two, money creation by government as spending. Although bank creation of money has been dominant in our country's history, there have been episodes of government creation of money. These includes paper money creation by the colonies, as advocated by Benjamin Franklin, the Continentals used by the Continental Congress to pay the cost of the Revolutionary War, and then the greenbacks issued during the Lincoln administration to pay for the Civil War. So let's compare the basics of money created by lending into circulation and spending into circulation. Now, when government creates money and spends it into circulation, the money circulates in the economy and stays there, except for the amount the government takes back in taxes. That's like the coins. Even that money, in fact, is spent back into circulation. So when banks create money by lending, however, it circulates in the economy for a while until the debt is repaid. And by having their loans repaid plus interest, banks actually take more money out of circulation than they put in, a seemingly impossible arrangement. It only works because the lending rate typically exceeds the rate at which loans are repaid. Bank lending creates money as credit, which means as debt. All of our money is on loan, and we are paying interest on all of it. And in order to have more money, we have to have more debt. When government creates money and spends it into circulation, no debt is created. The money created is a public asset with no debt attached. So what then are the consequences of this current system? Well, one is that wealth concentrates in private hands. Because all bank money enters circulation through lending, there is interest being paid to lenders on every dollar in circulation. A massive flow of money from the many to the few. In addition, when government borrows by selling bonds, taxpayers pay the interest, money again flows from the many, the taxpayers, to the few, the lenders. Now in this graph, you can see this distribution of net worth or net wealth. And as you can see, the top 10%, which is the left three columns, possesses 77%. That is to say more than 3/4 of the nation's wealth. You can see that the top 1% of the population has only 35% of the US net worth. Whereas the three columns at the right show that the least wealthy 60% have only 12% of the wealth. Concentration of wealth does arise from several sources, including regressive taxation policy and the monopoly pricing of goods in the marketplace. Both of these issues are addressed in the positions stated in the League's Impact on Issues. But so far, the League is silent on the third major way wealth is concentrated, namely by bank creation of money as debt. A second consequence of our money system, in which money is created by private banks, is that our government borrows to cover the gap between revenue and expenditures. If the government had taken in the same amount in taxes and spent the same amount and made up the difference by creating money itself instead of borrowing it, there would be no federal debt. Many economists, probably most, regard high debt levels as a sign of a country's economy moving toward trouble. In any case, the government pays interest on all the money it borrows, which constitutes an added expense to government operation. Legislators point to the high government debt as a reason not to spend on things the League advocates for, such as infrastructure, healthcare, education, environmental protection, and support for families. So that produces the austerity that we in the public sector through government experience. When proposals come before Congress for spending on these things, infrastructure, healthcare, and so on, the question is invariably raised as to whether we can afford these things, especially in view of the already high federal debt. But if we have the labor and the raw materials to do these things, why should a lack of money, which can be created by keystrokes on computers, prevent us from doing them? The fourth consequence is an unstable economy. When times are good and the economy seems to be growing, banks are eager to lend and people are willing to borrow. The longer those good times last, the more willing banks are to make riskier loans. All that lending increases debt. When something happens, it increases expenses or reduces income, such as the oil embargo of the 1970s. Loans begin to default. When that happens, banks become more reluctant to lend. Just when more money is needed to help people and firms deal with the increased expenses, the banks decrease the money supply. And the willingness of banks to make risky loans when times are good itself has led to loan defaults, as happened with the subprime mortgages leading up to and precipitating the 2008 recession. The current system of supplying money has caused some booms and busts and has amplified the severity of all of them. The busts always cause job losses and cause suffering to those on the low end of the income scale. The instability of the economy also makes planning hard for businesses. Small businesses with little reserves suffer the most. So, given these consequences of the current money system, it seems appropriate to advocate for change. But this, of course, raises the question, are there alternatives which will better support League values? Well, our Athens study group started out with a plan to study the current money system and to evaluate all the alternatives. Well, we found that impossible to adequately evaluate all of the alternatives and their possible consequences. But it was possible to settle on what we think are good guiding principles to use in evaluating options for monetary systems. So the study carried out by the League resulted in a proposed position statement. As you can see here, the League shall advocate for change in the monetary system in service to its commitment to government policies, supporting democracy, the meeting of human needs, and the promoting of environmental protection. However, this raises the question of just what changes are to be sought. What we were able to settle on in our study were 9 features of a monetary system that would support League values and positions on various issues. The 9 features will be described by Marie and Virginia, so I'm turning it over next to Marie.
Thank you, John, and hello, everyone. So as John was just saying, our committee came up with 9 features that we feel are essential to a workable money system. First one, A, the money system will provide a convenient medium of exchange with ease of use for all. Now, this is something very basic to any money system, and it's one thing our existing system does do well. So we included it because we want to make sure that as we make any changes to the money system, this one does not get lost. So then going on to point B, the money system will assure a steady value of money, providing economic stability, free from economy-wide inflation or deflation, regardless of increases or decreases in the productive output of the economy. This is one that our existing system does not do so well. The graph shows the ups and downs in the value of the dollar. And as you can see, it's mostly down. This is since the beginning of the Federal Reserve System in 1913. Now, right now, our central bank, the Federal Reserve, aims for a target inflation rate of 2 to 3% a year. So that means, of course, that the value of our money is going to be going down at that rate. The rationale for this is they want to allow for steadiness and predictability, but guard against deflation. Deflation is something they consider harder to deal with than inflation. The theory being that when in a deflation environment, people will hoard money because they think it will be more valuable in the future. So that slows down commerce overall. People are waiting to buy and sell things. So then that keeps the deflation in place. But the thing is that neither the federal government, the federal government nor the central bank have any direct control over the money supply. The Federal Reserve tries to use interest rates and the buying of selling of treasury securities to manipulate banks and investors into doing things that they hope will move the economy in the direction they want it to go. But they don't have any direct control. Now, if we had a money system where the supply was actually monitored and controlled directly, rather than being dependent on the whims of bankers and borrowers, then those kind of manipulations would not be necessary, and we might actually be able to achieve a steady value of the money. So then moving on to point C, the money system will allow for increases or decreases in the money supply as needed by the economy. So this third point is about how the money system would actually operate. The first two had more to do with the outcome, that it's convenient and it keeps a steady value. But under this third point, we actually came up with 7 qualifications for how it should actually operate. And those 7 qualifications combined with those first 2 is what composes our 9 points. Okay, so the foundation of this, point C then, is that the system should be able to increase or decrease the money supply depending on the current needs of the economy. So that's an important point, that it should be able to directly respond to the needs of the economy. So then within that mandate, it should do that in such a way that, 1, the economy is stable, eliminating extremes of economy-wide booms and busts, including recessions and depressions. I have a couple of graphs that I want to show you that illustrate what these boom and bust cycles do to equality and the overall wealth in society. So this first one, this is a graph of average net worth of US households at different levels of affluence or poverty, and it goes from 1989 to 2019. This comes from the Federal Reserve Survey of Consumer Finance. So each of the 3, on this graph, you can see there's 3 lines that are crowded together at the very bottom. Each one of those represents 25% of the households sampled. So those 3 lines are representing 75% of the households in the economy. And then the top 25% in this graph is broken out into 2 lines. So the next one up from the lowest is the next 15%, and then the very top is the top 10%. So now looking at the top line here, you can see that there was a peak and a dive when the crash of 2008 happened. So clearly the top 10% had a boom going. They had a steep rise before the crash, and then they did crash. But if you follow that line along, 5 or 6 years later, around 2014, that segment has recovered, and they're back into boom times. They have another rise going. And the next level down is a little more equivocal, but it looks like they recovered, or they almost recovered, but they didn't go into another boom. And then the lowest levels disappear on this graph because it was scaled for the top. So now in the next graph, in this graph, we scaled it to show just the bottom 3 levels. So it's stretched out. So the top level here is 300,000 instead of the 6 million that we had at the top of the last graph. Those in the top line here clearly participated in the boom, and then they lost wealth between 07 and 2010. But unlike the top 10% in the last graph, they still hadn't regained their pre-crash level even by 2019. Then you go to the next line down, it's similar, it's just a little less dramatic. But look at the lowest line on this graph. The wealth for that sector was right around zero all along the beginning of the graph, which is about 2 decades before the crash. So they weren't experiencing any boom. But with the crash of 08, the average net worth for that segment of the economy went negative by about $12,000 to $14,000 per household. And it just stayed there ever since. There has been no recovery in that level. This is what these economy-wide booms and bust cycles do. They ratchet up the inequality and they hit the poorest levels the hardest. For businesses, the results are similar. The boom and bust cycles, they make business planning difficult for everybody, but it's the smaller businesses that get hit the hardest. They're the ones that are, closing their doors, going bankrupt. Now, the money system that we have right now makes these cycles inevitable. As John was explaining, our existing money system relies on constant borrowing and payment of interest just to keep the economy supplied with money. And just as an aside, I want to clarify something here. The interest on all this borrowing that happens to keep our money supplied is not going just to commercial banks. Most bank loans are packaged into securities and sold to investors. So the interest from that's being paid on the money supply is going generally to investors and into the financial sector. So basically what that does is it's siphoning money out of the producing economy and into the financial sector. So that can create a booming stock market. But the debt burden on the productive economy, it just gets heavier and heavier till eventually it maxes out. And the producing economy can't afford to borrow any more money. It's too squeezed. So at that point, borrowing is going to drop off. People just can't borrow anymore. So borrowing decreases. And that, since we have things structured the way they are, that is going to decrease the supply of money. Well, when you decrease the supply of money, it becomes harder to pay for things, including loan payments. So then you start getting defaults, and that's when the whole system starts to just spiral down and into a collapse. So the way that we have the money system structured, those boom and bust cycles are inevitable because of that kind of a cycle. Now, if we were able to establish a money system that creates money as a public utility without creating corresponding debt, then we would not have these boom and bust cycles built into it. With a money supply that was not reliant on debt throughout the working economy, then when there are ups and downs in the market, it would not have to reverberate through every level of the economy the way it does now. Also, if money creation were under direct control of some governing body, then whatever that office or organization was, it would be in a position to respond to protect the economy from whatever ups and downs might be happening in the markets. Okay, moving on to point 2. No one is systematically privileged. Money creation is fair and equitable and benefits all, not primarily a subset of the population. So here again, we're talking about how money is created and entered into the system. As we've been saying, the current system is doing it by bank lending. So most bank loans get packaged in securities sold to investors. So in the system that we have, there is a strong benefit for banks and investors and a burden on just about everyone else. I did a little calculation on this based on the Federal Reserve's money supply report. In April of this year, the bank deposit portion of the money supply was about $19.5 trillion. So all of that was created by lending. So somebody somewhere is carrying an equal amount of debt and paying interest on it. I calculated a 5% interest rate, and it came out to $977 billion. And that would be per year. So that is a benefit that is flowing into the financial sector, the banks and investors. It's a pretty big benefit, and it's also a huge burden on the rest of the economy. This next slide is a graph of the growth of the financial sector over about the last 70 years. This is often referred to as financialization of the economy. You can see how there's just a rise, steepening, ever steepening rise happening there. Now, the money system isn't the only factor involved in this. John was naming some of the other factors with certain, tax issues and various other things. But the existing money system is locking in this enormous special privilege at this most fundamental level of creating the money. So again, if money were being created deliberately and without debt attached, then it could be entered into the economy without giving this special privilege to anyone. Now that covers the first 4 of our 9 principles. And at this point, I would like to turn things over to Virginia Hammond to tell you about the other 5. Virginia, all yours.
All right. Thank you, Marie. The next one is that the nation is able to spend what is needed to meet human needs and address climate change, limited only by the productive capacity of the economy. Let me tell you a brief story. In 1817, just after the Napoleonic Wars, the island of Guernsey, which is a crown dependency of England, was in pitiful condition. Roads were washed out, the market was falling down, the infrastructure was a mess, and nobody had any money. Their money was the pound sterling, but there was very little of it in the hands of either the people or the government. They had people who wanted to work, and they had materials to build and repair things, but what they did not have was money. A committee was appointed to look into how they might build a badly needed new market, and they looked at 3 possibilities for financing it. 1, increase taxes, which they knew the people could not afford. Borrow from banks, which would involve paying high interest, which the government could not afford. Or exercise an unusual prerogative in their charter and issue their own money. The committee favored the 3rd option, and eventually the government and parliament agreed. They started issuing Guernsey notes in specific amounts for specific projects. They built roads and a market and financed other projects. The money circulated on the island, and they went from poor to prosperous in a relatively short time. The point is, of course, money is a human invention, and its basic purpose is to enable the exchange of goods and services. So if we have something that we all need and want, and we have the materials and the willing and able labor, it would turn the system completely upside down to say we cannot do it because we don't have the money. Money is supposed to serve us. It shouldn't be the other way around. Most of us are painfully aware that we have a serious crisis going on with the condition of the planet. It would be insane not to do all we can to avert disaster based on a complaint of we don't have enough money. The creation of the nation's money is not used for private profit-making or gain. The benefits of first use of money go for the public good. This is similar to point 2, but we focus there on profit making. This next graph is of the US financial sector corporate profits from 1965 through 2021. Here again, you can see the financialization of the economy. An additional point here is the first use of new money. If money's created by lending it, then it goes first to people and businesses with good credit ratings. They're already reasonably well off. If money were created debt-free as a public utility, money creation would not burden the working economy with paying large profits to private corporations and investors. New money could be directed to where it's most needed, such as for physical and social infrastructure of the country. The creation of the national money supply does not require increasing debt. This is the core flaw in the existing system that's generating all its other issues. The next slide is a graph of money supply compared to aggregate debt in the US. The left column is money broken down into different forms. And the right column is debt broken down into household debt at the bottom, then business debt, then federal government, and then state and local governments. As you can see, debt is much greater than money. With our current system structured as it is, debt has to be greater than money, and it always will be unless we change the system. The situation we're in is that we cannot create money without an equal amount of debt, but we can create debt without creating any money. Anytime a commercial bank makes a loan, it creates equal amounts of money and debt. But anytime anyone else makes a loan, they create debt, but no money. We're working under a system that mandates constant debt. That right column represents about $65 trillion in debt, and interest is being paid on all of it all of the time. This is a constant vacuum cleaner draw of money and resources out of the working economy and into the investment economy. Like this. If the money creation privilege were taken away from the banks and money were created debt-free as a public utility, the foundation of this unsustainable, unjust system would be undone. If we could have a government that was not buried in debt and beholden to financiers, it might be in a better position to act according to the will and the needs of the people. Lending plays an important role in modern society for the purchase of expensive items like houses and cars and for investment purposes. But there's no reason for lending to be coupled with money creation. Banks can lend existing money on behalf of depositors who want their money invested, or they can lend from their own equity. This is what investment banks do now, and what most people think is happening everywhere. If we could end bank creation of money, it would do a lot toward closing that siphon of money from the many to the few. Number 6, the creation of money is not dependent upon economic growth for system stability and can accommodate an economy with no growth or slow growth. The system we have is completely dependent on growth. Economists, governments, and businesses have all learned that the only way to survive in this economy is to grow. Growth is touted as the cure for poverty, inequality, and almost any economic ill you can think of. Governments all over the world target their economies for 2 to 3% annual growth. When something grows by a percentage, it's multiplying itself. Over time, it will double. And then in about the same period of time, it will double again. That doubling is what makes it get really scary. That's called exponential growth. This slide includes a picture of a quilt I made called Sugar Rush to Oblivion. It is actually a representation, smoothed out, of the growth in the US money supply from 1913 to about 2020. So, and if you extend any graph of any exponential growth, it eventually develops that kind of curve you see in this quilt. It may look civilized and manageable and beneficial at first, but then the curve starts to steepen and then it goes almost vertical. This kind of growth is not sustainable in the real world. Because we have this extractive money system, it has forced the whole economy into a grow or die situation. The producing economy has to produce enough to sustain itself, as well as enough to sustain the constant drain of wealth and resources through the continuing payment of interest to banks and investors. Economic growth accelerates the consumption of energy and raw materials, which accelerates our negative impact on the planet. If the population continues to grow, a certain amount of economic growth is probably necessary. But as it stands now, even if we could achieve zero population growth, our economy would still need to grow to survive. This enforced growth is a major factor in our disastrous impact on this planet. We've become a nation of overconsumers because we have an economic system that requires it. Underpinning our growth-dependent economy is a growth-dependent money system. If we can separate money creation from lending, the money supply can be controlled in the public interest and without a growth mandate. Financial resources could be part of the solution instead of the source of the problem. 7, the national system of money connects to the global and other national systems in a way that privileges no nation, allows the people of all nations to benefit from the first use of their national money, and supports a sustainable future for all. The basic money system we have in the US, which allows banks to create most of the money by lending, is in use throughout the industrial world. The phenomena we've just been looking at of ratcheting up inequality and unsustainable growth are happening worldwide. Governments all over the world are manipulated and exploited by banking and financial interests because they're also badly in debt. In the aftermath of the 2008 crash, both Greece and Iceland provided graphic demonstrations of how democracy can be thwarted by government debt. There were a lot of different factors that came into play there, but before any of them could happen, there was a money system that allows banks to create money by lending, and that mandates perpetual debt along with perpetual interest payment. If we're able to change our money system here in the US to one that is truly fair and democratic, we'll have the opportunity to bring other nations along. We are the world's dominant economic power, so we're best positioned to lead, and we also have the biggest responsibility. We in the League promote international cooperation as a path to peace and sustainable prosperity. Changing our own money system here in the US can serve our own interests and also spread to serve the interests of the people of other countries. That is the last of our 9 points. And at this point, I'd like to turn things back over to Mary.
Be sure to unmute yourself, Mary. Mary, you're muted.
Our study strongly shows that the current money system undermines democracy by concentrating wealth and power. This prevents our elected representatives from carrying out the will of the people and from establishing policies advocated by the League. The money system is at the core of everything that the League of Women Voters wants to accomplish. The current system is a huge but surmountable obstacle to marshaling the nation's resources to meet basic human needs and addressing climate change and environmental degradation. In creating the structure for this proposal, we took into account that the League of Women Voters does not bring legislation forward. Rather, through our advocacy arm, we evaluate the extent to which various legislative proposals comport with our positions. So we have articulated here the criteria against which new legislative proposals can be judged. Over the past few decades, a number of bills have come forward to change our money system. Certainly more will come, and we want to prepare ourselves to respond. There's too much daylight between those of us with wealth and those of us in need. And public policy is currently generally poised to enlarge rather than shrink that gap. We in the League have many goals. Whether our personal passion attaches to climate change, gun safety, reproductive rights, school funding, food and housing security, voting rights, or all of the above. What happens around money is a critical determinant of our success in advocacy. We bring this topic to the League of Women Voters because it's time for a national people's conversation about the money system. It's time for those of us who have inadvertently ceded our right to the terminology and concepts of money policy to recognize that we are, in fact, smart enough to monitor and challenge the existing money structure. We believe the League of Women Voters is the perfect host for an ongoing, intelligent conversation among citizens who are variously affected by how money is created and spent. We ask that you support our proposal for a National League study of the United States money system. And that wraps our presentation. Thank you for your kind attention. You can read the League of Women Voters of Athens County monetary proposal at our local league website, which is at the bottom of this screen, athensleagueofwomenvoters.org.